right, thanks everyone for your continued energy and enthusiasm as we wrap up the evening. So for this final session, we'll have Peter from Notre Dame tell us about dividends, trust, and firm value for 20 minutes, and then Zach will discuss that for 20 minutes, and then hopefully we'll have a little bit of time before breaking for drinks and dinner. So, Peter Solders.
Great. Yeah, thanks for having us. This is joint work with my co-authors, Bobby, who's here, and Martin, and Rafa, unfortunately, is giving a final at the same time. So this is a paper about trust. And so psychologists think about trust as sort of the belief that you'll find what's desired in another rather than what's feared. So this has also been incorporated a lot in recent economic models. One of the seminal papers in this area is by Guizzo, Sapiens, and Gales. And the way they sort of think about trust in the financial context is the fear that you'll be defrauded, the fear that you'll be cheated. So we're going to think about that in terms of investors who are less trusting will likely view accounting fraud as more likely. Now, there are cultural and personal level differences in trust. Not everybody has the same level of trust. And what we're going to argue is that reductions in trust lead to a higher demand for dividend payers. So where does this hypothesis come from? Is that dividends should make investors less afraid of being cheated. So two recent papers are relevant for this hypothesis. So Ham, Kaplan, and Yuka argue that dividends provide information that substitutes for earnings. So even if people don't trust the accounting statements, they say, these accounting statements aren't real, they'll sort of trust the dividends because you're actually getting that money. The money is coming into your account. So think about somebody, you invest in a local restaurant with your friends. And then your friends say, oh, business is going great. Business is going great. You're going to get your profits eventually. It's going to be amazing. And then there's another friend who actually gives you money back. Probably would prefer to invest with the one who's giving me money back rather than the one who's saying, things are going great. Just sort of trust me. Additionally, another paper by my discussant and his co-author argue that dividends signal to investors that they will not be expropriated by insiders. So here's sort of the agency story. So trust, psychologists say, is engendered in situations where people do stuff that's in favor of the relationship, not in their own personal interests. So by paying out dividends, you're kind of restricting your budget set. Now you can't spend as much on these crazy investments that you want. You can't pay yourself as much. And so this should be good for the relationship. So this is sort of a way of engendering trust. So again, our hypothesis is that if dividends reduce the fear of being cheated, investors who are more afraid of being cheated will, all else equal, migrate towards dividend payers. So this is an important question in finance and accounting because we want to sort of understand why do people like dividend payers so much? Dividend payers have sort of tax consequences, yet they seem to be incredibly attractive. So just as a preview of what I'm going to talk about, we have 4 different parts. First one is we're just going to test our conjecture that dividend payers are perceived as more trustworthy, that they're less likely to commit fraud. So we do that in what we consider the most natural way. We just ask people, what do you think is the likelihood of fraud given different characteristics? Next thing we do is just sort of a suggestive correlation. So the Dutch, now it's the Dutch National Bank has these surveys, but the Dutch Center Savings surveys also ask these questions where they just ask people about their underlying psychological characteristics and then ask them questions about their dividend history. So we're going to show a correlation there. And then finally, for a more well-identified setting, what we're going to use is fraud as a shock to trust. So for example, I had money in FTX a few weeks ago, and my trust level was much higher for sort of financial institutions a few weeks ago than it is now. I'm still in FTX US, so I'm hopeful that eventually I will get some money back, but not that hopeful. So we're going to use this sort of as a shock to trust, the revelation of accounting fraud within your own portfolio. And what we're going to find is that mutual fund managers tend to tilt their portfolios more towards dividend payers after being exposed to fraud relative to those who are not exposed to fraud. Finally, we're going to show that this has some asset pricing implications. So if we think about asset prices as being set in sort of a supply-demand way, this should have asset pricing implications, and I'll go into that in a little bit more detail. So the first thing that we do, just I mentioned, we'll ask people, relative to the financial, reports of the average company, how likely is there to be fraud in the financial reports of companies that pay dividends to their shareholders? And people, on average, think that it is less likely that they are going to be producing fraudulent accounting statements if they are dividend payers. Out of all the accounting characteristics we asked about, this was sort of the most significant in terms of distance from 4. This sort of highlights the results from the Dutch survey, where people are asked to rate themselves on a scale of 1 to 7, where 1 indicates that they're very trusting, 7 indicates that they're suspicious. And again, our hypothesis would be that as people become less trusting, or as they become more suspicious, they should be more likely to receive dividends. And you can see sort of this pattern in the data. Now here's sort of the cleaner test that we use to sort of test our main hypothesis that lower levels of trust will lead to sort of higher demand for dividends. So like previous literature, we use fraud as a shock to trust. And we compare sort of mutual fund managers and their behavior if they had fraud in their portfolio within a given year with other mutual fund managers that operate in the same style within sort of the same year. And what we see is that in the year of sort of the fraud, and we use sort of leads and lags because our referee nicely pointed out that we should test for parallel trends. We see sort of that fraud investment is associated with sort of higher fractions of dividend payers in their portfolios and also higher dividend yields, in the sense that if a firm is paying out more, perhaps they're more trustworthy. Now, one possible explanation is this could just be risk shifting, in the sense that if you're exposed to fraud, you might sort of see a reduction in your wealth. So if you think about typical asset pricing models like the habit formation framework, this reduction of wealth would lead to sort of an increase in risk aversion. Increase in risk aversion, they might shift towards dividend payers because dividend payers have been shown to be sort of less risky. So what do we do to sort of test this? We just say, well, do they shift their portfolios towards less risky assets? And we use a number of different measures of risk that have been used in the literature, and we don't find any significant evidence that they are shifting their portfolios towards less risky assets. Additionally, there's sort of this literature that highlights there's a very strong distinction between the cognitive processes that govern trust and govern risk aversion. Somebody can be not trusting and be risk-seeking. I might take gambles at the casino, but I probably wouldn't take the same gambles at an underground casino because of the fact that I may not trust the person to pay me out, whereas I may sort of be, very risk-seeking in general. So the last thing we do is we look at asset pricing implications. So if there are these demand shocks and there isn't sort of corresponding supply shock, or at least not as large, we might expect to see that this has asset pricing implications. So we sort of motivate this with sort of 2 seminal papers in this area. One is sort of that stock prices follow a demand system where there's characteristic-based demand. People like dividend payers. This will lead to an increase in dividend payer shock, which is going to have significant pricing effects because of the fact that we tend to be in inelastic markets. Another simple theory that could lead to this is just people tend to pay more attention to dividend payers after fraud events, and so a simple Merton model would also generate these results. So identification strategy, in order to determine whether this actually has asset pricing effects, is to again use fraud events as a shock to trust and rely on the local bias. So there's a lot of evidence that people who live in California tend to invest in Californian stocks. People who live in New York tend to invest in New York stocks. So if people are exposed to fraud in New York, then on average, you should see that the asset pricing effects should be more significant for New York companies relative to other countries around the country, other companies around the country. So here I just showed the results with fraud intensity. And what you see is that a 1 standard deviation increase in fraud intensity is associated with about a 2% increase in the dividend premium. So in other words, the valuation of dividend payers relative to non-dividend payers increases by about 2% when there's sort of a 1 standard deviation increase in the fraction of firms that have committed fraud in that state. Finally, the last thing that we do is we look at something to corroborate this test. So this is a little bit less well identified. But one thing you might wonder, is this sort of just general trust, or is this trust specific to sort of accounting fraud, or is it both? So one thing is we look at cultural trust, which has been used by a lot of different other studies, and we see, are areas that are less trusting, do they have higher dividend premiums? And specifically, if their trust levels change based upon surveys over time, do we see changes in the dividend premium that are in accordance with that? So again, not as well identified, but should corroborate our past results. And you do see this, that sort of when regions become less trusting, based upon the fraction of survey respondents that respond that they're not trusting, then you will see sort of higher dividend premiums. So just to conclude, sort of we're arguing that low trust increases the demand for dividend payers. This sort of adds to the literature on why do investors like dividends. It also adds to the literature on the consequences of accounting fraud, in the sense that we're not only showing that accounting fraud has consequence for sort of equity market participation, but it pushes people into certain types of stocks. And these sort of portfolio reallocations can sort of have real consequences in the economy. And this can also affect their valuations. So thanks, and I look forward to Zach's comments.
Thank you very much to Stanford University and RAST for inviting me to discuss the paper. So I think this paper is sort of proposing a problem that investors face. How much should we trust managers? We all know that sometimes managers make projections that are too optimistic or too pessimistic. Reported financials are also occasionally fraudulent, but one thing that we don't really know is precisely how much to have trust in managers. And that poses a problem for investors, and it also poses a problem for managers. How do we reach out to less trusting investors and earn their trust? All right, so we're near Christmas, and I'm looking forward to my father, seeing my father-in-law, kind of. And the last time I saw him, my father-in-law told me that the Federal Reserve's balance sheet was a mistake. So can I say with certainty that he's wrong? No, but the Federal Reserve has very limited incentives to manipulate their reporting, and they're actually doing a lot of voluntary reporting that's not required by Congress. I would say the chances of misreporting there are pretty low. Okay, but again, there's a lot of heterogeneity in how much people trust. So the solution that they propose in this paper is that you trust managers with data. All right, there's credibility. So think about manager A. He expects to earn $3 a quarter. He tells you that, and then manager B expects to earn $3 a quarter, and he also gives investors $3 a quarter, so that you believe that he's actually earning that. All right. Conventions around, so what we're talking about here is investors, right? But you should also think about the payment of firms here, and the conventions around dividend policy established in U.S. literature are pretty consistent with this idea that dividends would help preserve trust. Okay, so dividends are very frequently cut, and managers of firms who cut dividends tend to get fined. All right, so there's about 33% of managers who cut or stop paying a dividend are replaced either that year or the next year. So there's a pretty strong incentive to not, promise this type of dividend payment that you're not going to be able to carry forward. And I think this, what this is sort of evidence on the intensive margin of how trust affects asset allocation. We already have evidence on the extensive margin that less trusting investors don't sort of participate in the equity market. So the intensive margin, it affects that. portfolios to improve. All right, so let's sort of discuss the evidence. Obviously, at this point, you probably gathered that I think the idea is intuitive and appealing. So survey evidence that they show suggests investors trust dividend payers more. I think that this is incredibly important in research. In general, the hypotheses developed should be consistent with what people say that they're doing, particularly in this type of a long run game where dividend policy is very persistent. All right, so I find that evidence convincing. All right, and then they also use fraud as a shock to fund trust. And I think that this is a very innovative way of unraveling the endogenous matching between investors. Okay, so you get a shock to trust, so you have a different investor on the other side for those investors that have been shocked and not shocked, and you observe that they are tilting their portfolios towards dividend payers. All right, they also have some suggestive evidence that trust affects valuation. I'm largely not going to talk about that, but I will sort of highlight that I think all the caveats. Okay, so summary of discussion. What I want to do is sort of put this in the context of the literature and have some takeaways about why I think this is a big idea. All right, for the dividend literature, I think establishing trust. I've interviewed a bunch of IR managers about why they pay dividends. And one of the things that comes out is that it enables them to reach out to a set of investors that are very interested in dividend payers. And one thing that I think is important from this paper is that by reaching out to this set of investors, you're potentially creating a signal that even investors you think of as very sophisticated can use. Okay? So I think that it's sort of foundational in that respect. One other thing that related to the trust literature, which Peter mentioned at the end, a lack of trust potentially deprives firms of capital through the need to pay dividends. Right? And I think you see this a lot more in developing countries where a lot of times in their IPO, they will say, we're going to pay 25% of earnings as dividends or 30% of earnings as dividends. That's not necessarily the right time in the life cycle of a firm to be disgorging cash to investors. So I think that that's something that you really should think about when you think about the takeaways from the statement. All right, so I think one of the things that I struggled with in the paper is that this notion of trust is just sort of inherently a little vague. And the way that they operationalize it, they're not sort of able to generate cross-sectional tests and cross-sectional predictions. So what I'm going to propose is that they conduct tests at the firm times fund times year level, and that's going to enable you to create interactions with firm characteristics. So basically what I'm going to do is I'm going to propose, a theory of how trust would impact financial statements, and then I'll propose to the authors a way in which they can test that to differentiate between some competing hypotheses. So sort of an example of one is, do investors trust the dividend itself? So is it just by dividend yield that you generate trust, or can you pay sort of a nominal dividend and then you trust the whole basket of financial reports? Right? I think those are very different theories and have very different implications for how we should think about this. All right. So to put this in the context of the literature, since Modigliani and Miller discovered that dividends were irrelevant, researchers have been trying to understand why firms pay them in spite of their irrelevance. All right. So there's a general agreement that dividends communicate some information, that firms are transmitting information along with the dividend to actual cash is sort of fungible between investors and receivers. And of course, in any type of equilibrium, the firms and the receivers would have to agree on the information. All right. So this paper is dealing with investors, the receivers of information. That literature is a lot more sparse than the firm-focused literature. All right. And the sort of primary finding in that literature is dividend clientele exists. So if you invest in other dividend-paying stocks, you're much more likely to invest in a particular dividend-paying stock than someone who does not invest in dividend. All right. So as far as explanations for this, there's one leading explanation, which is just sort of taxes. Just sort of obvious that if you're a pension fund, you can receive dividends without being taxed annually, so you can accrue income on the gains. Whereas if you're sort of regular investor, you don't have that ability. That explains about half of the preference for dividends. Okay, and this study argues that trust explains the portion. That's sort of where it takes the literature in helping us understand why firms sort of congregate in certain pairs. And then I think the next step would be to sort of quantify the magnitude. Okay, and then the properties of dividend cent, or sort of looking at the sender side, should be consistent with any type of theory that you have about the receiver. Okay, so investors are providing feedback through voice and exit to firms, and firms are communicating information, and those signals should be similar. So I think the firm dividend literature is broadly consistent with firms paying dividends to establish trust. So dividends are highly persistent, rarely cut. Dividend payers are less likely to manage earnings, so that builds on this trust idea as well. And then dividends predict future earnings changes and levels, and have implications for earnings. Okay? So I think these ideas are all very consistent with this idea that at the investor level, it's helping you reach out to less trusted investors. Right? So I think this is foundational. It relates to our understanding of the mechanism generating dividend signaling. So think of a group of investors who do not trust financials. Right? So the firm pays dividends in order to reach out to that group of investors, right, and increase valuation. And then among payers, the sophisticated investors are going to use the signal to value the firm. Among the non-payers, right, if you look like the type of firm that can pay a dividend, that's going to repel a certain class of investor and then encourage more people to pay. Right? And through that, it induces firms to signal with dividends. I also do want to, I'm using the word signaling. A lot of dividend signaling models have very complicated mechanisms where the firm is sort of wasting cash today in order to bring valuation forward. That's all well and good. I don't think it's necessary. What's necessary is if you penalize the manager for cutting the dividend, it's very easy to generate a signal at fairly low cost. Okay? So that's a very workable model. Dividends versus proposed by Kaplan. All right, so this is the first paper on trust and dividends. I think it seems like an important and intuitive observation. There's credibility in cash. You might ask me why, I have a few papers on dividends. Why would you ever try and, say that dividends engender trust? Well, I did. Argued that several variables collectively for trust, and these variables all showed more strongly when in the more trusted firms. All right, the referee made us remove it from the paper. The trust argument brings in additional, unnecessary, and ill-defined content. Ouch, right? Ouch. Right? So you might think that that's harsh. I like to think the referee was trying to be sufficiently concise that I could include the quote verbatim in the last. Okay, but I did include the word trust in our blog post to firms in developing countries use dividend policy to build trust. So I do think that this is a pretty important. All right. So I think the issue is that I want to understand the specific way that dividends involve trust. Trust is sort of a broad construct. You can think of a number of different stories for how it plays out in the matching process between firms and financials. All right. So my suggestion would be to conduct the analysis conduct some set of analysis at the fund firm year level, right, So you can have firm times year and fund times year fixed effects that'll absorb firm and fund variables. And your basic regression model would boil down to the percentage change in the holdings for firms that are held in either year T or T plus 1. And your coefficient is whether the firm is a dividend payer and whether the fund has been hit with a fraud. Right? And that interaction is very much in line with what you see in your paper today. All right? And you expect a positive coefficient on that. All right? So what you can still do is include another interaction. Right? The one that I have here is a simple REIT. If the firm is a REIT. Okay? And the reason why I'm including REITs is that REITs paying dividends are actually very different than conventional firms paying dividends. REITs are actually required to by statute. So there's very little trust sort of, being established there. And you can sort of separate these effects and see if the effects are stronger in REITs. And then let me propose some other suggestions that maybe are a little less straightforward. So I think you could also look at whether the investing firms cannot be expected to pay dividends. Right? So Snowflake trades at 27 times revenue because it's expected to grow. It needs capital for investment. Paying a dividend makes no sense for this type of firm. It would undermine its growth story. Alternatively, profitable firms with high book to market can be expected to pay a dividend. All right. So shock and trust, in my mind, is going to have less effect on my faith in Snowflake than it would on a firm that could reasonably be expected to pay. Okay. And then I have a couple papers that sort of highlight that weak investment opportunity firms convey more information with their dividends and less information with earnings, which I think is sort of highly useful. And then so the way the model would work there is you'd have some type of coefficient on character. You'd have some type of variable on the characteristics of dividend papers, and you'd expect most of the effect to be common in the firm. All right. So the way in which the dividend literature treats dividends is either you pay or not. There's actually a lot of variation in the yield. So two of the lowest yielding firms that I'm aware of are NGM, which cut its dividend and then set it at an abnormally low level because they wanted to sort of signal to investors they were thinking about adding that. And NVIDIA, who I've actually interviewed someone at the company, so they're yielding under 0.1%. And basically, at one point, they thought that they were having trouble reaching out to the right types of investors. So they started paying a dividend. Then they started growing a lot. It became very clear that they weren't really a dividend-paying firm, and they just cutting the dividend would be embarrassing. So they didn't. But this amount is meaningless. Whatever you think of dividend, NVIDIA, this doesn't really matter. Somewhat more controversially, I don't think these really matter a lot either. Okay? So Microsoft actually, I believe, pays the highest dividend. So I'm not sure that these types of dividends move the trust needle, and firms with really high dividends are often expected to cut dividends. Some of these resource stocks like archival, pay dividends more than 20%. Those aren't, they're not expected. All right. So here are the market trust firms. Cash would not fund. All right. So I'd expect that your effects are largest in these moderate yield firms, and that's sort of how you adjust the regression equation. All right. So bringing this forward to sort of accounting, so I think another big angle is: are we generating trust in the financial reports, or are we getting trust in the dividend? All right. So you can think of a situation where the only thing that you're doing with the dividend yield is you're attracting investors, and the level of trust is proportional to dividend yield. You can think of something else where it's engendering trust throughout the balance sheet. So something that you could do there is you have the earnings yield and the dividend yield interacting with the variable interest, and that would allow you to see that. All right. So getting into the specific findings, I think you can sell the findings a little bit more aggressively. When I looked at this paper, I only focused on the financial variables, right? Manipulating dividend changes in financial variable, a good counterfactual for paying a higher dividend is not having a female CEO. All right, so when you compare the dividend to these other variables, what you see is that the dividend is the only financial variable that increased valuation and trust. And in fact, these profitability measures go the opposite direction, right? So higher dividends, higher valuation, more trust, in profitability, you see a trade-off between higher valuation. All right, so comments on valuation. The story here would be tighter if you aggregated up the fund level trust shocks and examined the impact on fund level valuation, right? So you're sort of, I think that staying with this one setting, this one shock, which I think is pretty good, and then moving to a valuation context would be nice. And then payers with more funds hit by the trust shock should have higher valuations, and non-payers should have lower valuations. All right. So to conclude the discussion, I think showing dividends establish trust has important implications for our understanding of the role of accounting. The connection between commitment to return cash to shareholders and trust in financial reporting. We tend to look sort of inside financial statements and correlations within the variables to try and sort of establish, all right, this is trustworthy or this is not. I do think that sort of looking outside for signals that can sort of corroborate that perhaps it's an underutilized method in the literature. One other thing I'll highlight is that dividends are flexible. They evolve to resolve financial reporting problems as they come up. So obviously in the paper of the team, we sort of document that dividends internationally are in the developing world are matched to earnings to a much greater extent. And that is also true historically. One thing that you're seeing today, I believe, is that a lot of resource stocks are paying large variable dividends of about 50% of earnings. And I believe that they're largely doing it to avoid their stock price from increasing and attracting a lot of attention from regulators about why their investments are at all-time lows while the price of resources are falling all the time. So that's all I have.
All right, so we're going to do some Q&A. As prior times, there'll be folks walking around with microphones, so just you can keep your hands up so they can identify you. That'd be great. So, for example, Kevin over here, et cetera. And then when you get it, introduce yourself and ask your question. And here we go. I guess maybe Kevin doesn't have a microphone yet, or does he? Or Charles?
I'll go ahead and start.
Okay.
Now, so if it's always the cash leaving the hands of management going to shareholders is what generates trust. There's no reason you would look at dividends as opposed to dividends plus buybacks, or even looking at cash flows from financing. And given that I'm not sure it would generate trust if a company's just taking out debt to pay dividends or do buybacks.
Yeah, so I have looked a little bit at repurchases, or we've looked a little bit at repurchases. Facts are much weaker. I think the story, at least the story in my mind, is something along the lines of dividends are very salient. You're going to be getting them in your account. You don't have to trust that the dividends are actually occurring. Whereas repurchases, you have to trust the financial statements that say sort of, oh, we repurchased these shares, we did this in a certain way. It's definitely not as salient. I can tell you the stocks that I have, I am aware of whether they're dividend payers or not and what their dividend policy is. I have pretty much no idea what their sort of repurchasing strategy is or how it changes over time and things like that. So I think I'm very behavioral, and so I think it's sort of a investor-bounded rationality type story where dividends are just very salient, very clear that it's happening, and doesn't require trust in financial statements or what the firm is saying.
Okay, well, Kevin asked the first half of my question, which is the buyback part, but then you brought up the second part I was going to ask about, because Zach, I thought that was a great discussion, Zach, but when you pointed out that there were two reasons why people, look at one is taxes and the other one is trust. There's a third, which is quite important. There's a very big literature that says that there's a mental accounting reason, right? A behavioral reason, meaning that they're not fungible in people's minds. And so my question is, to what extent this relates to your main hypothesis, how much do you need this behavioral piece? Because presumably people can generate, their own dividends. So the issue is, what is the nature of the communication? Does it require some sort of mental accounting in which people put dividends in a different drawer mentally from some other payback method?
Yes. So I think you're sort of referring to the fact that one of the stories is that people want to sort of consume, and sort of firms will sort of dictate their consumption patterns by just sort of paying out dividends. They can just consume their dividend checks, and this will lead to better budgeting. I think that's sort of the common story in the behavioral literature. I think for our purposes, if I'm understanding correctly, there is some behavioral component in the sense that they must view sort of repurchases and dividends differently. And this was kind of related to the previous question, in the sense that if they didn't, if they didn't sort of have different mental accounting for them, or they didn't have some sort of bounded rationality where they didn't know what the repurchases were, then the implications should be pretty much identical, I think.
It's related to where does trust come from, right? Is it because you gave me cash? Or is it because you committed to give me cash? Or is it, what part of this communication process is giving me more trust?
Yeah, I think it's because of the fact that they're actually receiving this cash in their actual accounts, whereas they're not just sort of seeing an increase in liquidity. That's my own opinion. But maybe that doesn't fully answer your question.
I mean, I think that they're committing to return this cash, and they will suffer career consequences if they don't. And as a result, you sort of have this, information signal that establishes trust. I think your mental accounting thing is almost certainly true. I mean, if you look at an investing website, almost any investing website, the dividend yield is one of the first 8 things, and the buyback yield or total payout yield is just not present.
Hi, Michael Jung, University of Delaware. I want to extend the thought process about receiving the cash. I want to ask you about what do you think, how does trust affect what investors do with the dividend? And what I mean by that is whether they decide to reinvest it back into the stock that paid the dividend and increase their position, or because they are less trusting in the first place, they don't reinvest and keep the cash and do something else with it.
Yeah, that's, I haven't thought about that. So sort of the idea would be, if it's just a trust thing and not a consumption thing, then we would expect to see more of this just immediate reinvestment. And so you could perhaps identify the different types of clienteles based upon the fraction of people that are immediately reinvesting it. I mean, it's not going to be perfect identification, but it's not consistent with the consumption story. As to what less trusting people would do versus more trusting people would do, I think that's an empirical question. I don't know the answer, and I don't know of any paper that's looked at that. But
well, just sort of clarification. If you're less trusting and you want to invest in dividend payers and you receive the cash, but you reinvest the cash back into the same stock, does that defeat the purpose of less trusting? Because now you're even more trusting of the company that paid the dividend.
Why does that make you more trusting of the company that paid the dividend? Your allocation would be sort of the same as it was before the dividend.
Well, you're
right?
receiving the cash, but you're not keeping the cash. You're just putting it back into the same stock. So it's a little bit, I know it's a little bit circular thinking, but it's just wondering how trust affects the reinvestment decision.
Okay, yeah, maybe I need to think about it more. Yeah, thanks.
Yeah, just in terms of differentiating between sort of 3 basic economic stories, I don't know if there's a way, what you've already done would help do this, but if you think in terms of, am I learning about the firm itself, that it's a more stable firm, that they're signaling that? Am I learning about managers' trustworthiness, right? That I've got, managers that are inherently more trustworthy, right? And then versus the structure of the arrangement itself sort of inherently being more credible, that if I've got, a promise that I'm going to make to you, and that promise is to pay a dividend of a certain amount every year for the next, or every quarter for the next, essentially forever, that's inherently a kind of implicit promise, relational contract that is, more robust or has some other nice property that makes it naturally something that sort of, facilitates trust.
Yeah, I think that right now, I don't think maybe my co-authors would disagree, but I don't think our tests sort of speak to the different types of mechanisms which could underlie this. I think maybe some of the proposed tests that Zach had could sort of shed some light on the different underlying mechanisms. And so I know that I'm eager to sort of explore what these different predictions would be.
Yeah, I have a similar reaction. Is it a manager-specific effect or is it a firm condition effect? So this is bringing back memories of teaching corporate finance at the University of Michigan more than 20 years ago now, it must be. And one of the key things about dividend paying is it's a way for the manager to commit to not shirk. And so it's an agency constraining device. And that might be a way of the flip side of looking at that is that then investors are able to trust the manager. And so if it is a managerial effect or manager-specific effect, you could look at manager-specific fixed effect when the managers switch firms versus when the firms, if it's a firm-specific effect, if the firm's increasing dividends, is there more trust now? Are you getting stronger effects when the yield is actually biting enough to be a commitment?
Yeah, I think that's definitely reasonable. I mean, my intuition, which you may not care about, would be sort of that it is more firm specific than manager specific, just because like doing some introspection when I invest in a company, I'm not thinking too much about sort of the specific manager and whether I trust him, but whether I sort of trust the firm culture overall. But of course, it's an empirical question. Yeah, we can look at that, like you said.
Oh, we've got maybe one up front here, and then also Maureen. Thanks, Richard.
Yeah, Richard Sloan, USC. Yeah, by paying a dividend, you're disciplining yourself to go back to the capital market if you need that money to reinvest. And I'm just in your empirical tests, it's trust about fraud, and that's the trust variable that you're using. But it seems like there's a whole other area that's just this trust about not over-investing free cash flow that you're also addressing by paying a dividend. That, without naming companies now, there's a few cash-rich companies now that are investing in. Investors aren't happy about it. So I'm wondering whether that's just a whole nother element of trust that you could test empirically in the paper. Not that I'm saying you have to do it in this paper.
Thank you for that clarification. As you're our editor, so I suspect that what you say is the most important. No offense to everybody else in the audience. Yeah, I think that is something else you could test. It's not immediately obvious to me how you could do a clean test of it. You can look at definitely correlations there, but sort of getting a well-identified test is a little bit not obvious. Maybe Zach has a good idea. Seems to have good ideas about this.
So my question relates to this theme of alternatives that the manager can do besides dividends. I mean, obviously we talked about repurchases or stock dividends. I would also say if the issue was around not trusting that the financial statements will, that the manager won't cheat you and that there'll be a financial fraud, possibly doing internal control evaluations that aren't, required. So for the firms that are non-accelerated filers and don't have an obligation to do a 404 controls evaluation, potentially, actually voluntarily doing that. I don't know if any firms do that, but the question is sort of like, what would be the relative cost of that relative to paying out dividends when you're a young growing firm? And is the 404 so costly that you would just never, you'd rather pay out cash that you really wanted to hang on to?
Yeah, so I guess, so your point is there's other mechanisms you could pursue in order to make people trust your financial statements more. What is sort of the cost benefit analysis of the different strategies? I don't know the answer right now, but that's, yeah. So
I hope that you'll be able to pursue that with this line of trust, like, maybe in a future paper, but yeah.
I mean, dividends are not a mechanism to resolve trust issues for young firms for the reasons that you outlined. So what you see is dividends predominantly paid, by firms where the cost of the dividend is very low. And they're probably not incurring costs except to avoid cutting. I mean, that's my general.
So I was wondering if you've considered the possibility where, so I like that, or I find that test interesting where you look at mutual funds changing their tilt towards dividend-paying stocks after frauds in their portfolio. But I think there's some evidence to suggest that frauds happen on a cyclical basis, right? During peak market times, after which there's a reduction in growth opportunities. And so then like it might be in the mutual fund's interest, besides putting trust aside, that they tilt towards stocks that are dividend paying because of lack of growth opportunities rather than because fraud took place. So fraud could be capturing some cyclicality in growth opportunities, aggregate growth opportunities. Is this something you've considered, or?
Yes, so we're comparing sort of mutual fund managers with sort of other mutual fund managers that operate in the same style in the same year. And so to the extent it's not immediately obvious why it would affect sort of the mutual fund manager that had sort of the fraud in their portfolio, more so than another mutual fund manager that operates in the same style in the same year. For the asset pricing test, we've done things where we look at things like GDP growth or like local GDP growth to get a sense of the underlying economic conditions and how this affects sort of valuation as well. And you do find some effects, as you know, in the direction you're kind of hinting at. But the results from the fraud itself are still very strong within these asset pricing tests, which may have been what you were more directed the question towards.
All right, I'm going to use my authority as the moderator to issue you a dividend and let you go to the bar. Zach told me that was a great joke. It was his, actually.